So, I mean, if you see the period 2006 to 8, you didn't see very many Indian companies or other sort of going in and acquiring those assets because it was just not viable to bring Australian coal, thermal coal into India. Coking coal, there was no choice because there are hardly very few countries in the world which have coking coal. There's still some interest in that, but everybody believed that there is no viability to bring Australian coal into India because transport cost itself, shipping and local transport over there, it will never be viable. Now, other transactions we are doing now, and these are the prices that have actually been achieved. I mean, as you can see, in case of coking coal, they have been almost 3x of what was forecast, and in case of thermal, again it's been almost 3x current prices. So, that changes the dynamics completely. Now you can look at thermal coal, even if there's a $15, $20, $25 cost, and even if you need to spend billions on creating transport infrastructure and then ship the coal all the way to India, there is definitely logic to the transition. That is why we see a lot of interest in a lot of transactions happening in Australia by Indian companies. A lot of it is really driven by what's the long-term outlook on prices. But having said that, let's face it. I mean, it's a guess. Everybody is trying to make their best estimate. In 2006, I'm sure all the world analysts had a way to look at the world, and they did make certain assumptions. Unfortunately, the world behaved completely differently. A lot because of China also. But a lot of it. If anybody is doing a deal on the basis of DCF, the assumption conviction has to be sort of coming from inside. They have to believe that this is what sort of works for us, and this is what we really believe in. Because there is definitely a lot of risk associated with this. And the other point in terms of discounted cash flow, whenever, and I know a lot of you would be doing it, is so there are certain points on WACC which we see, and when we see practitioners doing it or companies doing it, there are certain points which we keep in mind, which we tell the company or practitioner is that what the discounting rate that you should use has to be current based. So you may have a debt which is at very low or very high level in the book. All the cost of debt, cost of equity has to be based on current debt. And I mean, the debt equity ratios that typically used in India, we are used a lot on using book debt equity ratios. That would mean book value of equity and book value of debt, because that's the way banks see it. But when you do a cash flow, that method tends to under report WACC and overvalue the company. I mean, it's typically better to look at a market-based debt equity ratio. Then I think the most important point is on cost of equity. And why you will derive your cost of equity from beta, from cap, but just remember to look at leverage, because leverage impacts a lot on cost of equity. And typically, when we do it, we do a lot of adjustments on account of size, client, is there a concentration risk, leverage, and then business plan. Typically, one should not try to adjust business plan aggressiveness on the WACC side. I mean, you should address the business plan in the business plan and tune it down or tune it up to make it what you believe to be ideal or reasonable. But I mean, if there's no choice, some people use a way to add that in the cost of equity also. Then another challenge that we faced is what WACC to use in M&A, especially when you're on the buyer side. And this is especially true in the cross-border context, because if you are an Indian company and typically you are looking at a WACC somewhere in the region of 12 to 15%, but when you go, because your debt cost is going to be that much and equity may be probably closer to 17, 18% sometimes. On the other hand, when you go to a developed country, you will find that the other bidders, and suppose you're in a bidding situation, you find that the other bidders are probably bidding at 9, 10%, 11%. So that becomes a challenge. You sort of bid out. Similarly, you may have situations where Japanese companies are coming and bidding in India, and you would think that they would come in with a 5%, 6% WACC. But typically, what one needs to do here is really look at, most cases you should look at a target WACC. Unless target WACC is unrealistically high or unrealistically low, you should not operate. Because if you take an asset, if you're coming from India going into a country which is more developed, lower WACC, then you'll find that slowly your risk, your capital, cost of capital will also start moving down. So similarly, if you on the other hand are investing in countries which are much riskier, for example, we know that in oil we found that some companies invested in very risky countries in Africa. So there the VAT that they used were almost higher than 20% because you had to factor in the country risk and the target risk. So ideally one should keep in mind the target VAT while bidding. That's what you believe in, unless it's significantly different from what you believe ideally it should remain at. And also, especially your funding strategy. So if you are going to be acquiring an asset and your funding cost is going to be much higher than others, and it's going to remain that way, then it's going to be difficult to just take a target that and not look at your own value. Which brings us to our next method, which is the comparable multiples, which is where basically you look at price earning or enterprise value EBITDA multiple and benchmark on this basis. Now this is again realistic method because it sort of compares with how the valuations are trading in the market. There's much less assumption in this. There's much less bias, much less assumptions, and it's relatively flexible. You can use different multiples depending on different industries and different situations. But I think the limitation of these markets are significantly volatile, and so these methods also happen to be significantly volatile. And a lot of times we find, although principally one should believe that markets are fair at all times, but a lot of times you may believe that markets are not fairly valuing a number of companies, and especially you find that if you take out the top companies and some of the companies below them, sometimes may not be fairly valued. And the reason we are saying that is not because of what we believe is market is doing, but if you compare some of the private transactions, private equity transactions versus how they are in the public market, you will find that there are significant differences. So from that perspective, we find that some of the valuation in the market may not be reliable. In terms of uses, I think what we find is some sectors there is very difficult to do discounted cash flow. Sectors like software, where there is a visibility, challenge to visibility beyond 1 year or 2 years, we find that multiples are a much better method because I just can't say what Infosys are going to do 2 years down the line, and you haven't seen the cycle, you don't know how things would behave. So from that perspective, you find certain sectors much more amenable to multiples. And typically, I think it's a good practice to take forward multiples if you have a better visibility on, let's say, next year numbers. Or if you say you have visibility even on 2 year down the line numbers, then you can take even multiples which are more forward. But if you have visibility of 3-4 years, then you might as well do this year. That's the view I usually take. But if it's 1 year forward numbers, one can definitely benchmark because markets will always be valuing on the basis of future growth, at least 1 year growth forward. So that's a good basis to value. And obviously the important point to keep in mind is PEG. And I just want to discuss something on PEG. Basically, one way of looking at it is what is the earning growth and what is the multiple you're paying for that. So PE to growth. Only limitation here is, it becomes very difficult in a high growth industry, and you don't know how long this high growth would last. And so one should be very short term growth, and one should look at more long term if one is giving a multiple on the basis of PEG. And I take this example, which is slightly dated, and again I must thank Uday Mukherjee who sort of pointed this out in certain case. I haven't updated because it goes all the way to 90, in fact 91, 92. And if you look at Infosys, people used to value it, they used to surprise every year, and I'm talking of early 2000s. And every year they would grow at more than 100%, triple digit growth, and people would just keep on valuing that basis, and stock would just keep on going up. But then it became a stage where people said, oh, 100 years old, let me just take it 10 years down the line. In 2020, 2010, this stock will be this much, this company will be this big. So let me put it that. So you had a situation in 2003 or 2002 sometime when Infosys had if you see the PE growth, PE chart, it almost had a 200, 300 PE chart. Because people said, this company is growing at 100%. You just forecast 100% for 10 years and just see how cheap it is. So you fell into that trap. But what happened was, if you see Infosys has really grown, it's always grown. So there's a growth chart towards the left, the profitability is always grown. But those guys who came in 2002, 2003, for 5 years they never got any returns. This is despite Infosys growing every year. It's just that the expectations got corrected and people realized that the growth may be slightly slower and the impact on stock price was significant. So the whole point here is just look at long-term growth, and just remember that you may have phases in which there will be super normal growth, but they may not last, so there's that much more risk attached to that.